Last week, VICI Properties, ticker symbol VICI, released their fourth quarter results as well as their end-of-year results for 2023. In their fourth quarter report, the company announced that their revenue had increased 21% year over year and that adjusted funds from operation also increased 17% year over year. On a per-share basis, their AFFO increased 8.8% year over year to now 55 cents. For the full year 2023, total revenues increased 38.9% and AFFO increased 29.1% to now $2.2 billion. They also announced and originated $1.8 billion in acquisitions and investments in 2023 and deployed capital in every month of the year. Regarding these results, CEO Ed Pe-toe Knee Ack made the following comments on their earnings call. VICI's 2023 AFFO growth will likely make VICI one of the 2023 income growth leaders among the 29 S&P 500 REITs that report AFFO per share. Our investment activities in 2023 produced growth in our portfolio quality, geography, diversity, tenant diversity, and income. It wasn't easy to produce future growth in 2023. It was tough to navigate in 2023, but even amidst the low visibility, the VICI team kept pioneering. Despite a more challenging environment for real estate investment trusts and speculations of a recession, VICI Properties continues to show that they're a world-class REIT with a great management team and an outstanding property portfolio. The company was created back in 2016 after a spin-off from Caesars Entertainment. Originally owning just Caesars Entertainment properties, VICI continues to expand their property portfolio over the years. Today, the company owns 97 properties, which include 54 gaming destinations, 39 other experiential properties, and 4 golf courses. VICI is most well known for their real estate on the Las Vegas Strip. This REIT owns some of the most popular hotels and casinos in Vegas, including the Venetian Resort, Caesars Palace, the Mandalay Bay, the MGM Grand, and several other locations. In addition, they also own 2 convention centers in Vegas, as well as have 26 acres of undeveloped land which they intend to use at some point in the future. Aside from their Vegas assets, VICI also owns properties across the United States, especially in Atlantic City, plus they also own a racetrack. In October, the company announced that they had finished acquiring 38 bowling entertainment centers in a sale-leaseback transaction with Bowlero. This recent move in acquiring bowling alleys was met with some mixed reviews. Some people have issue that bowling alleys don't really align with VICI's core, which is casinos and resorts. Also the fact that bowling isn't as popular of an activity as it once was decades ago. But there are some good benefits to the deal that align with VICI's goals. Looking at Bowlero as part of their portfolio, you'll notice that these 38 properties have a weighted average lease term of 55.1 years. If there's one thing this REIT loves, it's acquiring properties that have very long WALTs with them. This means that the average Bowlero property will be paying VICI every month for the next 55 years. The longer the WALT a REIT has, the better, because this can help better predict cash flow. Most REITs have WALTs that typically are around between 8 and 12 years from what I've come across. VICI's WALT across their entire portfolio is currently 42 years, which is one of the best you can find in this field. All of their properties are still triple net leased, which means each tenant is responsible for covering taxes, insurance, and property maintenance. VICI is also able to increase the rent on their current properties at a rate much faster than other real estate investment trusts can. With a large percentage of their rent coming from properties located in just one city, some people might have some concerns about the lack of diversification geographically. Although they have become more diversified since their launch in 2016, a big part of VICI's success still depends on how attractive Vegas is as a tourist destination. When the pandemic hit, Vegas tourism took a massive hit, and it's been well known that the number of people visiting this city has been taking a while to recover. Fortunately, some good news recently came out which shows that tourism has more than fully recovered since the pandemic. Tourism rose in 2023 by 5.2% to roughly 40.8 million visitors. While that is good news, it's still short of their best year on record where they had 42.5 million visitors. In terms of hotels, they reported record profits in 2023, with the average room in the city going for $191 a night, a 12% increase from the previous year. Hotel occupancy in Las Vegas averaged 83.5%, which is up 4.3% from 2022. Considering the fact that Vegas just hosts the Super Bowl and the fact that sports betting continues to grow in popularity, analysts are pretty optimistic that 2024 might be Vegas's best year on record. These kinds of numbers translates into VICI having a dividend that's well covered and continues to provide growth. Their annualized dividend growth rate is currently 7.6%, which is significantly better than the industry average. For an experiential REIT, they're in first by a wide margin when compared to gaming and leisure properties, GLPI, and EPR properties. Both of those REITs went through dividend cuts when the pandemic hit, but VICI was able to make it through and not only sustain their dividend but also grow it in 2020. As of their most recent quarter, VICI now has an AFFO payout ratio of 75.4%, which puts them in a pretty comfortable position. So with all this good news and the high quality features of this REIT, it's also worth pointing out some challenges and risks that come with this company. As is the case for all REITs, VICI's share price performance continues to be very lackluster while interest rates remain high. The reason for this is because REITs borrow a large amount of money to do things like acquire properties and fix and upgrade them. But because VICI is a triple net lease REIT, they fortunately don't have to worry about the upgrades and the maintenance part. Still though, even when purchasing properties, borrowing money becomes a lot more expensive, and this negatively impacts income for the REIT. Investors know about this, and as a result, investors haven't been as willing to buy REITs in the last couple of years while rates remain high. Now, if you're a seasoned dividend investor, you'll know that times like these make for great buying opportunities. Purchasing higher quality dividend growth stocks that are trading at massive discounts means that you're getting a much higher dividend yield for your money. That's what makes REITs more appealing to income investors right now while rates are currently still high. Until the Feds cut rates, the share price of VICI will almost certainly struggle to recover back to over $35 per share like it was trading for in 2022. So that's the first issue with this stock, which isn't too bad and it's only a temporary thing. A second concern is that some people are continuing to speculate about a future recession that could hit. The kinds of experiential and vacation properties that VICI owns are almost always the very first things to get cut out of people's budgets when times are tough. And although I think this is technically a threat, the fact the company made it through the pandemic unaffected shows that they're an extremely well-run company that's better at fighting these kinds of situations. The third concern, which I think is the biggest threat compared to the others, is the company's ability to keep growing at the same quality looking further down the road. VICI loves to hold properties with very long WALTs and that are very prestigious. However, there's only so many of these types of properties that exist. I guess they could try to purchase the entire Las Vegas Strip, but they likely wouldn't get a good deal out of that, which wouldn't make it ideal at all. There's just a limited number of entertainment properties that exist that have decades-long leases and are recession-resistant. If VICI wants to keep growing at their current rate, they'll likely have to lower their standards when it comes to acquiring more properties. When that'll have to happen is hard to say. VICI is still a very small REIT as they have less than 100 properties in their portfolio. There's still plenty of options that exist for them, so I don't see this being an issue in the immediate future. But maybe in 10 or 15 years down the road, I think it's at least a credible threat to their growth. In the end though, there aren't any major issues that I see coming from this company. VICI continues to report really good earnings during a more difficult period, while other REITs have been seeing slower growth. In my opinion, they're the best experiential REIT out there, even though EPR pays monthly dividends and GLPI might come with a slightly higher yield. VICI's track record continues to be really impressive, and I'm betting that it'll continue to be that way for a while. But with that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.